Hi, David. It's very nice to meet you. And thank you for joining us this evening and doing this interview for us in Japan during your busy schedule.
Hutch, a pleasure to be here, and thank you for having me.
The name Rockefeller is very well known throughout the world. Please explain the evolution of how Rockefeller Capital Management came to be and a little history about the company. And what has changed since the creation of your family office and what has remained the same?
Yeah, so Rockefeller Capital Management has, as a legal entity, been in place for a little over 3 years, and it evolved from the Rockefeller family office, which had been in place for well over 100 years or so dating back. So a long history of a family office. With Rockefeller Capital Management, a couple of important changes. One, a big expansion of our business to the high net worth audience. And by doing that by adding offices in many cities throughout the US. So I believe we now have offices in 18 cities around the country, where before we were in 4 cities. So our reach within the United States to more families is much bigger, broader than it's ever been, and that will continue. And then we added another interesting business that's very complementary, and that's strategic advisory. So this is advising on banking deals and really targeted to our high net worth clients.
Interesting. So many people immediately associate Rockefeller with the oil industry, but how did the family and your firm come to focus on ESG investment?
Yeah, no, it's a great question. And I think the focus on oil really is almost a reflection of what generation you come from. Older generations think of Rockefeller and Standard Oil, and younger ones might think of just the Rockefeller Center and not be aware of the oil history. And so this ESG actually goes back to the earlier generations came out of the descendants of the grandchildren of John D. Rockefeller. So it's what's known as the cousins generation. It's the 4th generation of Rockefellers. John D. Rockefeller Sr., the founder of Standard Oil, being the 1st generation. His great grandkids were very attuned to environmental issues, and these were the kids who grew up in the 1960s and in the early 70s. They wanted to have their values reflected in their investments, and so it wasn't known as ESG back then, but it was the DNA of what's ESG. It began in the firm back in the 70s with that. Back then it was more about exclusions of what companies you didn't own more than what companies you do own.
On ESG investment, please tell us how you make investment decisions, taking ESG into consideration.
Yeah, so less on exclusion and more of ESG as a tool for identifying risk and return potential. And so we think about it in many dynamics. One is what companies are improving their ESG profile. We've back tested and seen a big correlation between companies whose ESG scores improve over time, and we have our own proprietary scoring system, and that's a helpful tool for identifying improving companies before the traditional equity analysts would identify them. 2, when you're very in tuned as a research entity to the key ESG issues, it helps with idea generation, because we have a very keen sense of what companies have the right services and technologies for where we believe a lot of money will be spent, especially when it comes to combating climate change.
Other than ESG, could you please explain your investment style and the investment process? How do you pick stocks? Do you factor in the macro scenarios, rising interest rate, for example, in that process? Also, please explain your investment discipline and perhaps your investment AUM, please.
Yeah, and let me just start with the AUM. We're managing about $12 billion US, some in fixed income, the overwhelming majority in equities, and the majority of equities, and these are public equities, would be in ESG equities. And our style would be considered fundamental, bottom up, global framework, your question about rates. If we have a differentiated top-down view, we will express it in portfolios. The reality is, things like interest rates are hard to forecast, and and there's a lot of eyeballs trained on this data that are trying to make these forecasts. So when we have differentiated views, we're very happy to utilize that as a roadmap for finding ideas. And as a case in point, we've viewed climate change as a multi-year, really multi-decade challenge that's going to drive spending in a whole range of industrial companies. And so this has been a view we've had for a while, and how do we express it in portfolios? This is part of this is a top-down ESG framework, if you will, really driving bottom-up consideration. Reality is, as global investors, we can express this any number of ways because we're not wedded to geography. So if we think about that opportunity, which we think isn't just going to be driven by an infrastructure spend in the US, although it's certainly helpful, but it can play out for years and decades. Who are the leaders that are going to benefit from this? Well, we think that when it comes to industrial companies with solutions for the climate, European companies actually lead the way because they have been combating climate change sooner than American industrial companies have. So if we look at many of our portfolios, they're just chock full of European industrials that have, we think, very proprietary technology, services, products geared for where we think spending will be for years to come. But we are disciplined on valuation, so we will not pay everything. So if you look at the EV sector, we're big believers that the world will move off of fossil fuels as fast as it can. It will take time, but internal combustion engines are in mark time, and you see Volkswagen making very aggressive statements about how fast they're going to move, much quicker than folks thought. General Motors, we believers in the space, but we care about valuation. And so when you ask about our style, we can have a theme, but they're often the way we are playing it is less obvious than the first way you think about it. So we think about EVs, its many component suppliers has been a direct way we have thought about playing it. And so this means we're marrying valuation to themes and thinking about where the best, most attractive risk-adjusted return lies.
How often do you come with a new idea, new stocks? And once you identify the stock, you decided to make an investment decision, usually how long do you hold?
Yeah, that's an excellent question because it really is a function of the environment you're in. So if we go back to 2020 felt like 4 or 5 market cycles all compressed into a 12-month period because there's just so much volatility, whether it was headed into the pandemic, coming out of the pandemic, you had a big pivot in the US elections. And so in normal times, the amount of volume and turnover in our portfolios might be about 30-35%. So it would suggest an average holding period of 3 years. And then you can have an environment like 2020 where there's stocks we bought in June that we had exited in September. And that's a bit of an anomaly, but it can happen. So for us, it's about valuation. Would we buy them today? So we've had stocks, some stocks 10, 12 years longer, and we're very comfortable to own them and let them compound. But in unusual times, we can veer from that formula.
So you make a decision because you believe the stock has reached the full valuation.
Yes, so we want to be disciplined on valuation. If we see better risk-adjusted opportunities, we will exit a position. And so it's as stocks approach, we set target prices. As they approach our target prices, we may just start paring them down because the remaining upside is just smaller. And conversely, and this is an important component of portfolio management, when a stock disappoints and it sells off, if you still believe in it, we think it's very important to add to the position because it probably has more upside, but its weight in your portfolio is smaller. So a $50 stock that's as a 2% position that you think is worth 60, if that sells off to 40, well, instead of a 2% position, it's a 1.6% position. And instead of 20% upside, instead of going 50 to 60, you think it's going to go from 40 to 60, it's 50% upside. So the pure math is, why hold 2% of something for 20% gain compared to 1.6 for 50% gain? It should be flipped on its head. So for us, an important part of this question and portfolio management is this kind of discipline. Is we all like to think about the sell discipline, but the buy discipline, and when you add to positions, is equally as important.
So you have a universe of stocks that you like. Once the stock reached the ideal price to start investment, then you make investment. And when it reached the full value, then you think about start selling.
Yeah, generally speaking, but there can be companies that we like that we just don't think are attractively priced. But if something changes, we can get in pretty quickly. So for some stocks, it takes weeks to do the research. Some, it's a much quicker process. And often there are companies, and there are companies we have owned that we have exited a couple of years later. We're okay to own them because something's materially changed, whether it's the share price, valuation, new growth prospects, new management.
Mm-hmm. And your typical U.S. portfolio, how many names do you own?
U.S. portfolio is typically about 40 stocks in the portfolio.
Okay.
So we like to keep, reasonable concentration, at the same time, be sufficiently diversified.
Mm-hmm. Back to ESG, please tell us about your recent ESG efforts, and ESG improves the index. How is it differentiated from other ESG indices on the market?
Yeah, we think we have a very unique approach with this index, which is something that we have collaborated with Bloomberg, who are professionals at index creation, and we have supplied our factors on ESG improvement. And so most ESG indices are just focused on ESG leaders. And so you're screening out companies that score well in various metrics, whether it's low carbon output or scoring well in governance and the like. But they're often recognized, and it shows up in their evaluation. For us, the alpha opportunity is to find these companies before they're leaders, while they're on that path to becoming leaders. So we've done this research, back tested a number of years, but very good about identifying our formulas to identify ESG improvement. And they go back 10 years, and people say, well, why not back test longer? You'd have the data longer. I mean, this is relatively new and cutting edge here, even to go back 10 years. Try to get systematic reporting ESG factors 20 years ago, it didn't exist. And even today, it's better than it was 5 years ago, better than 10 years ago. But we feel really good about even being able to get 10 years of data, measure improvement, use that as a basis for creating a universe that we think will outperform on a purely factor-driven basis versus a broad-based index. And so that this Bloomberg Rockefeller's Improvers Index is the new creation that was just launched at the start of the year.
I think there is the perception that ESG investment would sacrifice performance. Therefore, ESG investment is the right thing to do, but it may not be a good idea from investors' point of view in terms of performance. Is that true? If so, why? If not, why not?
Yeah, no, I disagree with that. I think first, let's break this down into the components. GE governance, I think governance is part and parcel to understanding companies. So yes, good governance matters. We see so many opportunities just focused on the E, on what environmental challenges mean for companies, both in their growth opportunities and also if you are on the wrong side of the ledger and you have environmental liabilities, you certainly want to know that. So if you look and measure this empirically, E and G have always scored very well on there. If there's a debate, perhaps it's on social issues. Does that have as strong a signal? Arguably, it may not. But I think if you look in totality, ESG portfolios have done really well. Big part of it is they signal the fact that fossil fuels are in long-term decline. There are periods when you can make money owning energy stocks. Most ESG portfolios have a very light weight. Some have no weight in it. And frankly, that hurt them until 2014, late 2014, almost 2015, when oil prices really rolled over. And since then, it's actually been a real tailwind to ESG performance. So if you look, if you go back before 2014 and you looked at ESG portfolios, they may have lagged on oil. They've done much better than broader markets since, and that's because it's teased out where the real growth opportunities are. So I think, ESG has been strongly correlated with outperformance. This is, 6 years now, 6 years plus, where it's been really strongly positioned.
Can you please share one or two examples of ESG names that you like? What is the process and methodology you use to assess this company's value? And once you have made your investment, how do you engage with that company?
Yeah, happy to. And so I actually just finished Bill Gates' book recently on combating climate change. And what I liked about this is, Bill's a numbers guy. I try to be a numbers guy. I'm not as good a numbers guy as Bill, probably no one is, but he lays out climate change issues very matter-of-factly, what the challenges are. And in it, he highlights the best return on investment you get from fighting climate change is on building insulation. And it was music to our ears because one of our longtime holdings is a company in France called Saint-Gobain, which is a building products company, and they are leaders in insulating buildings. And if we look at where the spending that the Biden administration is proposing, a lot of it is to insulate schools. We have lots of old infrastructure. We're going to build all new schools. Maybe we'll build some, but the most cost-effective thing to do is insulate these schools. And Saint-Gobain would sell at 10 times earnings because this was viewed as a cyclical company. It goes up and down with the business cycle, except we're looking at potential multi-trillion dollars of stimulus here, really geared towards this. There's going to be a lot of money allocated for insulation. If you have 5-10 years of visibility and earnings growth, I think you get a nice multiple expansion. So we've seen the stock really take off after years. It didn't really digest what we thought was a very good growth opportunity. Now the market is starting to become aware of it, and I think there's more runway to go. It's still well below market multiple, even though we like the growth prospects. So another company I also mentioned, a different way of playing similar theme and spending of combating climate change is TE Connectivity, which makes connectors for electrical equipment, electronic equipment. And we think about that traditionally, you might have seen it as stereo receiver or computer, but the biggest market for that are cars. And the biggest market in cars for this are EVs, which have so much computerization. You probably read about the chip shortage and you realize how much computer content is in cars now. TE Connectivity is a way to play EVs without playing the big obvious companies that we think have some really hard valuations to stomach. So TE, we see a really long runway of growth. They don't have many competitors. It's a really consolidated industry with a couple of companies leading the pack. And it's just really a second or third derivative way of playing what we think is going to be a long-term growth theme on electric vehicles. So they're listed here on the New York Stock Exchange, Saint-Gobain in France.
Interesting. Thank you. Now, I have a few questions which actually came from the Japanese individual investors who wanted to ask you during this opportunity. I appreciate you could answer them. First question is, how important are the quarterly earnings when you make long-term investment? Some say sell when the company has had the bad numbers through the long-term story, while the long-term story is still intact.
So I would say the contrary. I first, when I was talking about portfolio construction earlier, often those opportunities present themselves when a company does have bad quarterly numbers and the markets overreact to it. So if you believe the long-term growth is there, there's often very understandable reasons why a company may have a bad quarter. In fact, you should become suspicious of companies that always beat by a penny or two, that they're just managing the accounting a little too closely. So anytime a company, a portfolio company of ours, and it will happen from time to time when they have a difficult quarter, we're always going to look very closely. Is this an opportunity? Should we be adding more? So quarterly earnings for us often are an opportunity to take advantage of short-term market inefficiencies, because I think to many investors, they put too much emphasis on quarterly earnings.
Mm-hmm. What do you think are the merits of being individual investors and of institutional investors?
So individual investors often just have some really good insights and keen insights. And so it's important to know what you know and also know what you don't know, and try not to be overconfident. But there's often folks that come up and they have ideas, and you can get good ideas anywhere. So I think individual investors, many of them are just very in tune with markets and what they're doing, but not always. And it's easy to be overconfident in a year when everything is going up. And this is, I think, that the scariest part about this environment is it's been a little too easy, it feels, to make money. And many individual investors are coming in, and we see this weird anomaly now with the meme stocks in the US on there. And so you worry about some of the individual investor behavior versus institutions probably wouldn't be in there. But the advantage of being institutional versus, institutional, you get lots of flow of information, which is super helpful on that. And so the flip side is, if you have too much assets to deploy, you're never going to be as nimble as an individual investor. Now, that said, we want to be mindful of trading too much. If you're an individual investor, I just think it's too much trading and riding the hottest theme. Play for the long term, stay disciplined, stay focused. Don't try to trade. If you trade too much, you're probably going to make the wrong moves at the margin in down markets, selling out in down markets and buying near the top as well. It's very hard to get those things right.
Mm-hmm. What are some of the economic indicators that you pay most attention to?
I like the information embedded in the bond market, because bond investors tend to be a little different than equity investors. If people invest in the stock market, they tend to get a little more euphoric. Bond markets investors tend to be more pure numbers driven. Mm-hmm. And so I like to look at the yield curve, the shape of the yield curve, but also look at inflation protected bonds, what it implies for real interest rates, what it implies for inflation near term, out term. And I think there's a lot of really good content embedded in bond markets, what they're telling you. I also like to look at the forward curve. If we look at the forward curve of oil, a lot of folks will look at the spot rate. Well, oil is out to $60. If you look at oil 2 years out, its price is no different than it was pre-pandemic. It's had a big rally, but it only implies it's a very short-term rally in oil. So if you're investing in oil stocks, what multiple do you put on something when the markets, the forward market's implying that it's really not going to be sustainable, a high price of oil for the next 10 years? It's just it's a very short horizon. So futures and forward curves are actually very important to look at. In the US, the one data point most investors point to is the single most important is the non-farm payrolls. Normally it matters a lot. It's still heavily distorted from COVID. It's been distorted for 13 months. It's going to continue to be distorted. In normal times, yes, it matters a lot. It will move short term. But you have to know when it's going to be limited. Right now, I put limited faith in what that's saying. I put more faith in what the bond market's telling us about future growth.
Mm-hmm. How do you manage your risk when you can only long stocks?
Yeah, no, excellent question. First, it depends how you think about risk. If risk is losing purchasing power over inflation, that's different than just losing money in a nominal sense versus a real sense. And in the US, we're very geared to thinking about real purchasing power, and it matters as we think about risk. When you're long only equities, you want to make sure they have pricing power during a recession when rates go up, because let's think about what really moves stocks lower. It tends to be recessions for two reasons. You have an earnings shortfall, and then you have the compound effect of lower multiples that happen during a recession as investors get nervous. So what are businesses that are going to be relatively resistant to that? And so we do look at quality of cash flows, what companies can earn throughout an investment cycle, And if you do have some overreactions, you really want to encourage clients to take advantage of that and add to it and smooth those returns out. So one of the best things psychologically is look at trailing 3-year returns, not quarterly returns. And one of the worst things we can all do as investors is look at your retirement account every day. And that's a recipe for a disaster, because you might immediately make the wrong moves at various inflection points. But the reality is there's very little you can do in the short run in down markets if you want to have enough equities to have meaningful return over time and over inflation.
How do you make a decision to sell stocks?
Yeah, no, usually it's if my brother-in-law owns them, I think it's time to get out, because I feel like it's the last person that's owned a stock is on there. But in all seriousness, it's being disciplined about valuation is important. It's not a perfect guide. You always have to ask yourself, if you didn't own it, would you buy it today? So what you don't want to do is fall in love with it. At the same time, I think investors can trade too much, and just because a stock hits a target, you should probably reevaluate it. It doesn't mean you should automatically sell. So what we have is a reevaluation process, and if we can't justify a higher price, then we will exit it. And that's the discipline we bring to it. And if something changes fundamentally in a company, that can change our outlook on there. So we always have to be objective and ask ourselves, would we buy it today? But I would just caution this: just because a stock has moved a lot doesn't mean you should exit. If you think about the poor investor that bought Apple 20 years ago, was up 50% and sold it, it probably felt really good for a day or a week, and years later, like, what was I doing? And if you think about the great companies that built wealth over time, whether it's Apple, Amazon, Facebook, Google, they've been a lion's share of returns in equity markets, if you find a handful. So if you have good businesses, you may just want to give them the benefit of the doubt if they're really good, strong, growing businesses, versus more cyclical companies where you feel like, yeah, you grabbed a valuation opportunity, but its growth is going to be limited over the longer term.
Do you have a few books that you could recommend for high school and university students to study the basics of stock market investment?
Yeah, there's so many good books on there. I mean, I've always been a big fan of Michael Lewis's work, and he's written many that relate to Wall Street. But before Michael Lewis, one of my favorite authors was a fellow named Peter Bernstein, who was an economics consultant, and I had the pleasure of meeting Peter many times. He worked well into his 90s. He wrote a book called Capital Ideas years ago that was a history of Wall Street and how everything going back to like the turn of the 20th century, so 1900 on, things evolved, and how he analyzed various concepts and how everything came to be. And I thought it was the great foundation of investing and that he put together. And then he wrote a second book called Against the Gods, that was all about risk and understanding risk and how risk came in being in portfolios. I couldn't think of any better way. If you are interested in investing, it's not going to give you individual stock tips. What these books give you are a foundation for understanding principles of investing in a history, because there's so much important history behind it. And I thought he was just a great writer, how he did. So I couldn't recommend those highly enough. And I'm pointing those books out because they're not the ones you often hear on short lists that are more recent books. These have a lot more shelf life, in my view, because they have such a long historical context.
When you make a decision to start investing in a stock, in general, how long do you spend to build the position?
So it depends on liquidity. A position can be built in a day. Maybe it takes a couple of weeks. We don't mind owning companies in a smaller part of the market cap spectrum, and we'll be patient building something up. But usually it's not going to take more than a week or two. The most of the stocks we're going to buy, we'll build a position in 3 or 4 days on there. But there are exceptions. But a couple of weeks, would be probably the most it will take. And often we just don't want to disturb the price and just participate with the volume.
No one knows where the stock bottom is. Therefore, it is best to do the dollar cost averaging for retail investors. What do you think about that idea?
Love it. And that the reason I think it's so important is it takes away some of the behavioral decision flaws we all have as individuals. We're just, people are just fallible. We just make repeated behavioral mistakes, and getting too pessimistic at a bottom, getting too euphoric at a market top. When you dollar cost average, you take the emotion out of decision making, and it's a really important part of investing.
What would you think is the ideal period to do the dollar cost average for retail investors?
If you can dollar cost average, whether it's monthly or quarterly, and do it over a couple of years, or if you're going to be doing investing for a number of years, just put a little in every month or every quarter. And this is why retirement plans, as they build up, are a very useful tool for doing it. It forces you. Think about the dollar cost averaging, the benefit last February, March, April, that it probably was painful, but just stuck to it. You're like, oh, I'm so nervous. Everything's coming to an end. We're going to have a depression for 10 years. I don't want to buy. And the S&P is at 2,200 and on its way to 4,000. I mean, it's just not easy to do emotionally. That forced discipline is a very good one, but it's not an easy one to do. So this is where you really see the benefit of it.
I think you're talking about the overall market investment, right? How about individual stock that you think it's a wonderful idea, want to make an investment, but don't know where the bottom is? For that kind of investment, how long would you say, ideal period to start the position?
So when you talk about individual stocks versus the broader market, often there's the catalyst that moves stocks a lot is their quarterly earnings report, we were just discussing. And so if you're considering buying a stock, you may consider not investing in it completely if they're going to have an earnings release. And perhaps you're going to invest 50%, maybe 2/3 of what you're complete, and then save some to buy after the quarterly report. And that's a way of averaging it. But you don't need to I wouldn't take that long. Frankly, if you're really convinced that this is a great company you want to own for the next couple of years, the next couple of decades, don't get too cute is my advice. But maybe average it in before and after the reporting period, because there are, especially smaller companies, there's plenty that will drop 10 or 15%. What you don't want to do is, wow, I lost this money, I'm frustrated, I'm out of the stock. It's probably when you want to be able to buy a little more.
Mm-hmm. On your website, I found an article that says copper is a new generation, a new metal super cycle. Would you care to explain the ideas behind it? And would you also tell us what specific stocks that might be beneficial on this theme?
So copper captures a few things. Copper, there's always the nickname of copper called Dr. Copper because it was a predictor of economic activity. So anytime there's a pickup in economic activity, copper is used in about everything we do, whether it's pipes, whether it's wires and the like. So there's always this correlation, high correlation with copper and economic activity. Now you add in all this spending and inflation, and well, if you have inflation, metals usually keep their value. So as an inflation hedge, it's a good hedge. You have a natural rebound from COVID. You have infrastructure, and add to this EVs because copper is an important component in electric motors for electric vehicles. So the planets are lining up in a big way for copper. The way to play it, there's some big copper mining companies give you the most leverage to the price of copper. If you want to play copper, you could buy the commodity, but if you own a miner that is producing copper, you stand to benefit as well. Now, you may want to own a mining ETF. It gives you a little more diversification. If you own one miner and they have a mining accident, there can be a lot of liability associated with that. So you can diversify that easily. There are mining ETFs which would give you exposure to copper.
Mm-hmm. And how long would you expect this super cycle to last?
I really think we are at the cusp of a 20-year spending cycle. If you think about the amount of cars in the world, and I used to know this figure is quite substantial. The auto fleet, I think in the U.S. alone, it's 250 million. I think in the world, it's well over $1 billion. I think it's 1.3 billion, but I could be off, so please don't quote me. Every year we're selling more and more electric vehicles, but you're also selling the amount of new cars are going up, and you're not replacing everything that's already on the road. So there's still a lot of internal combustion cars, and it take a long time to replace them. Even if Volkswagen is selling 50% of their cars are EVs by 2030 or 100%, you still have a lot of internal combustion cars on the road. This transformation plays out probably over the next 20 years. The whole auto infrastructure changes, trucking infrastructure changes, electricity being delivered changes, where that's delivered, the whole electrical grid gets reinvented. This is a big new spending challenge. So think about, we built all these high-speed internet pipes, they're in great shape, all the telco spending we've had for years. Now you're going to see more physical infrastructure spending, in my view, and it's not going to be done overnight. It's going to take years to deploy, and that's just going to be one element of climate change. Well, climate change creates, unfortunately, is an investment opportunity, because it's going to be expensive to combat, and you want to be on that side of where the spending is if you're an investor. And you got to be mindful of who's going to be bearing the cost as well. It is a net cost combating this. It's not going to be costless, but there are companies that are going to be really well positioned for this.
The U.S. now has a new president. What is your thought on the next 4 years in the stock market compared with the last 4 years? Are the next 4 years going to be easier to make money or more difficult to make money versus the past 4 years? What do you think?
Frankly, the last, 10 or 12 years have been easy, except for 3 weeks in March. We had the fastest correction ever. So it's an interesting time with Biden. We're on the precipice of something unprecedented. We're going to have the fastest natural economic growth because we have so much pent-up demand coming out of COVID. And that's going to be the fastest growth everywhere. Europe, when they get vaccinated, they're going to have their fastest growth in years. US will. The difference here is we're turbocharging this with a lot of fiscal stimulus. So we would have our fastest growth in years, but it's going to be even higher than that. So this is going to be really record growth, maybe the highest since the early 50s that we see in the US, and maybe even higher. Now, how much is the market discounting is really the important question here, because valuations are high. So I think that should give some pause. I think you're going to have certain sectors should look pretty good for returns. The broader market, will it reflect that? That's going to probably be weighed down somewhat. It depends how much some of these technology companies, how much more they can add in terms of valuation. And they have very large index representation, many of them. But the economic visibility in the US looks really good for the rest of this year, next year. I'm optimistic these vaccines will work and that there won't be another wave this fall. And that's a big caveat. If this thing mutates and these vaccines don't work, are we going to be able to get new vaccines made and deployed in time? So assuming that we don't have that, you have a very good economic outlook. When you have a strong economy, usually the markets don't have an excessive pullback. The risk is going to be in the caution when the spending is done and what happens to rates. Is there a big overhang on there? And so, there's always risk in equities. This is why my hair was a lot less white when I started this business than it is today. There's always some risks here.
So it's gonna be, it's not gonna be this year, perhaps next year or the year after. What do you think?
Look, there's always risk of correction. I think if you're an equity investor, you have to accept that. What you want to avoid is a risk of a prolonged bear market, which you usually don't have until you have a recession. You probably don't have a recession in 2022, at earliest 2023. Would the market sell off if Biden's plans don't go through, or if he ends up with a higher corporate tax rate? Yes, this is correction territory. You cut 10% off of the S&P, and that can happen at any time. I don't want to dismiss that risk.
Right.
20, 30% type of bear markets, unlikely when you have very strong economy and good earnings growth. And that economic visibility probably extends through 2022. But you could have gridlock again in 2022. We'll have another election. and all that spending will come to an end if we have some fiscal gridlock in DC.
Mm-hmm. Okay. Lastly, the long-term consensus view is that U.S. has more favorable macroeconomic outlook than Japan. For example, rising populations and also a relatively higher GDP growth versus Japan. Can you please give us your general thought on the long-term stock market outlook for the U.S.?
Yeah, the U.S. still remains a very entrepreneurial society. A lot of capital formation, venture capital industry is alive and well and constantly funding companies. Companies are very focused on generating return. All those conditions are what you want to see in a market, and which is, it becomes a victim of its own success. You get high valuations here because this is where the fastest growing companies are. So long-term outlook, U.S. companies is good. No question about it. It's going to be the dominant, in my view, dominant market still for technology, although you're seeing important companies in Asia that are doing quite well, so it won't be the only market for technology. Europe does trail behind. Europe's strength is going to be industrials geared towards climate change, but US and the fast growing sectors on information technology and really health technology. We're on this cusp of a genomics revolution, how disease is going to be treated. Look at the miracle of this mRNA technology for vaccines. I mean, we've never had vaccines this fast. What is going to happen in healthcare in the next few years, I think, is remarkable. At some of the technology for detecting the cancer detection in blood tests that didn't exist before. The U.S. will lead the way in these type of businesses. You'll may get fast followers in other places, but this is the long-term hope for the U.S. is it constantly reinvents itself to where the growth opportunities are. The world overall has demographic challenges. Japan certainly does. Korea really does. Even the U.S., we're not going to grow as fast demographically as we had. So GDP growth, when we get past fiscal stimulus, will slow down again in the U.S. as well. But you still are going to have very fresh, innovative companies that are going to find ways to grow their earnings well above what economic growth looks like.
So innovation sounds like the key word.
Innovation absolutely is, and all this technology just begets more technology. I mean, we're going to see, continued, just really interesting new businesses and services. All this technology keeps creating more tech. It just accelerates it, and especially, I think where we have the biggest unmet need, I keep going back to climate change. I think in healthcare too, we're at the cusp of a big change that's going to happen here.
So it sounds like it may not be a bad idea for Japanese to continue to make investment in U.S. stock market.
Yeah, and frankly, you've had a nice little currency tailwind as well with the yen weakening here. So U.S. has been, it's a good place for long-term investors. I caution, dollar cost averaging, love the idea, and don't fixate too much on quarterly earnings.
Got it. Well, David, thank you so much. It's been a great answers. Thank you for doing this in your busy schedule again.
No, pleasure. Hutch, very nice to be here. Thank you for the time, and wish you all the best.
Thank you very much. Have a good evening.
Thank you, and good morning.